Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Devon Energy, ticker symbol DVN. This was suggested by a subscriber, Omaro1910. He asked, can you do a video on Devon Energy or your thoughts if it's a discounted stock? Thank you, Omaro, for the comment. I really appreciate your support and giving me the idea to look at a new stock, because I always think it's interesting to look at some stocks that I might not have considered, and sometimes you can find something that you want to own that you never knew was out there. Devon Energy specifically operates within crude oil. I kind of wanted to highlight this snippet from their 10K, specifically with the Delaware Basin, sorry. The Delaware Basin is our largest and most active program in the portfolio, with operations in southeast New Mexico and across the state line into West Texas. Over the past several years, we have built an industry-leading position in this basin. Through a capital-efficient drilling program, it offers exploration and low-risk development opportunities for many geologic reservoirs and play types, including the oil-rich Wolfcamp, Bone Spring, Avalon, and Delaware formations. With a significant inventory of oil and liquid-rich drilling opportunities that have multi-zone development potential, Devon has a robust platform to deliver high-margin drilling programs for many years to come. At December 31st, 2024, we had 15 operated rigs developing this asset in the Wolfcamp and Bone Spring formations. The Delaware Basin is our top funded asset and is expected to receive approximately 55% of our capital allocation in 2025. From this screenshot and from doing my research into Devon, it looks like they're contributing a significant amount of capex into their growth, which is something I really like as a long-term investor. You do have to take into account that this stock is very, very highly affected by the price of oil, but if you're comfortable with that, I think that this might be a good time to get in, specifically because the stock is down 24.36% over the past year. It has a market cap of $22.80 billion, a staggeringly low price to earnings ratio currently of 7.61, and an annual dividend yield of 3.6%. It has a 52-week low of $30.39, and it has a 52-week high of $55.09. It's currently trading around that 52-week low of $34.71. So I think that this might be a good opportunity to get in while the entire market's crashing, but you do have to consider the opportunity cost of, if you're going to buy Devon Energy, you're missing out on some of the bigger players that benefit more from economies of scale, but you are getting a lot more growth opportunity, and I think that this stock is being overlooked in general. So I think that this stock is probably undervalued, but I also think, just because I tend to be a little bit more bullish, I'd like to think I'm neutral in a lot of ways, but I think I tend to have a little bit more of a bullish bias. I think most stocks are currently undervalued right now, other than defensive plays, which is why I've been kind of reviewing more tech stocks. But I think that Devon might be very good play if you want to get into the oil industry with relatively low risk compared to some of the other higher valuations that we've looked at, like ExxonMobil, like Chevron. Devon Energy has 30 analyst ratings currently, with 20 out of the 30 recommending either strong buy or buy. The analyst price targets range anywhere between $43 to $67, with an average analyst price target of $49.28. All of these price targets are above the current price of the stock, so that tells me that it's probably undervalued and it's probably a safe play. But again, you do have that risk of oil prices and the volatility with that, and there's plenty of that. So this is kind of a riskier stock fundamentally than an energy transfer that just depends on demand for energy to increase. I have talked about this many times on the channel, but I expect global energy demand to be increasing with the new AI data training and data centers as well, along with just more production happening within the world and the infrastructure that's going to be needed for the manufacturing of electric cars, the manufacturing of the actual power grid that's going to be needed to use that. I think that energy is becoming a lot more of an important thing over time, especially with the advent of AI, but you also have to add all of the other infrastructure that we're adding every day into that. I think that this is probably on the safer side, and I'm a really big fan of the energy sector in general, which you could probably tell by my big holding in Energy Transfer. Now, I do kind of want to highlight this before we move on to the DCF and get kind of a good valuation for the stock. The stock has a very unreliable, kind of sporadic dividend, which I think is a good thing and kind of a bad thing. So it's a good thing because they're returning the equity that they know they can't use to grow the company more back to the shareholder, which I always think is awesome. But it's a bad thing if you rely on constant dividends to survive or retire or anything like that. If there's a bad year in Devon, you're probably not going to get the same amount of yield from a special dividend that you're going to be getting in a good year, obviously. That's something to keep in mind if you're an investor who wants a consistent, reliable dividend. This probably isn't the company for you, but if you're an investor who has a long time horizon, I think that this is a relatively cheap option compared to a lot of the behemoths in the oil industry. Now, let's move on to the DCF valuation because I thought it was really interesting.
Here we have the weighted average cost of capital for Devon. I really expected a higher total debt amount compared to their market cap. You can see here that it's only 29.02% compared to the market cap, which comprises 70.98% of the total value of the company. We can see that the cost of debt after tax is 3.453% and the cost of equity is 9.402%, which brings our weighted average cost of capital to 7.68%. I do want to say that I think this is being heightened by the beta, which can move stocks in a way that I feel like isn't really good for a model. So this is probably going to be a more conservative estimate of the valuation of Devon. Additionally, I wanted to say that I modeled this based off of the average free cash flow of Devon, because if we look at the 2024 ending year free cash flow for Devon, it is negative. And that is because they have invested a lot into CapEx, specifically towards growth. And Wall Street tends to not like that because Wall Street has a more narrow-minded, short-term approach towards stocks. And I think that this is evident with a lot of different stocks that are pretty much on sale right now. I think Devon's kind of included in that. They're putting more money into their assets to make more free cash flow into the future. So I think that it would be inappropriate to model the entire thing off of the 1 year that they had a negative free cash flow when it's their second highest year of revenue over the past 4 years. We can also see that Devon has a average revenue growth rate per year of 13.7%. This is obviously quite good for an energy company, but again, like I said before, it is very variable from year to year because some years the price of oil is greater than others, and this is going to greatly affect their business. That's kind of the biggest risk that we have here. We also have, green energy sources kind of taking the spotlight, but I don't really buy that they're going to be able to replace oil and natural gas. I think that they're more of a supplement. I think that there are a lot of advantages to having green energy, but we're not at the point as a society, and I don't think that we're going to be at the point in a society that we're not going to be using oil. So I think that those concerns are kind of a moot point, in my opinion. However, we do have to consider that the average free cash flow growth rate is negative 46.28%. This is obviously being skewed by the 2023 to 2024 year, where revenue actually grew, but like I said before, CapEx spending was very high. And we can see here that with just a simple growth rate of 3% on average over the next 9 years and a perpetual growth rate of 2.5%, there's currently 37.15% upside to this stock. Now, I don't think that this is necessarily a perfect way to model Devon, just because I think that you're going to have large variations in the free cash flow, and that's evident just because of history and the type of business that this is. But I think that this is a really good time to buy, and I do actually think that this stock is probably undervalued. Now, keep in mind that I'm not a financial advisor, and this is not financial advice, but I think that this is a very strong play to get into oil for a cheaper price up front than you would be paying with some of the oil giants. And I think that this stock hasn't really been discovered in a lot of ways. And I also want to say that I think that this stock is going to greatly benefit from the higher demand for energy from the entire world. If you know anything about economics, you know that when demand increases, quantity supplied will also increase, and the price is going to increase as well, because there's a finite amount of oil available in the market. And if there's a higher demand for it just overall, then that's really good for oil companies. Now, I do think that this stock is riskier than Energy Transfer or some of the other stocks that we've reviewed on the channel that are companies that own the actual pipe infrastructure, because they are solely reliant on demand. That's the only thing they care about. Devon also cares about the actual price. So there are a lot of things that affect the supply of oil, including OPEC and just other countries and, different groups, production metrics, political things can affect the value of oil. Future politics can affect the price of oil. So the U.S. is kind of a very unique case along with Europe, where their energy companies are very subject to different green initiatives that happen. I don't think that this is a near-term problem with the Trump administration. The classic phrase, drill, baby, drill, is something that's echoed repeatedly by Donald Trump himself. So I think that this administration is very healthy for Devon. So I think that there is probably more likely an upside than a downside. But if you plan to hold this stock into the future, when there inevitably will be a liberal president, they're probably going to have weaker than expected results just as a result of those types of regulations. So that's something to keep in mind if you're a long-term investor. You also have to keep in mind that the dividends are relatively sporadic and unpredictable, with relatively predictable fixed dividends, but then there are variable dividends that come in. But I actually think that this is a plus, because Devon is giving back to their shareholders the money that they can't figure out how to use to increase their growth. And I think that that's very healthy. The price to earnings ratio is also one of the lowest that I've seen. The one thing that you can say about this stock that does hurt it is that they're not able to have the same level of production or maturity or predictability that an ExxonMobil or Chevron has. But again, they don't have astronomical amount of debt. And I think that this sector is really being undervalued as a whole. And I think that I'm going to be honestly adding this instead of an Exxon or a Chevron, simply because I would rather have something that has a lot more growth vectors, that's investing more into increasing their production rather than keeping a mature, stable dividend. I would rather have growth personally in my portfolio, because I have a longer time horizon and I'm currently time rich, not money rich. So I think that this is an interesting thing that I'm going to be adding to my own portfolio, even though I think it is riskier than Energy Transfer. But there is always opportunity cost, and there is a lot of unpredictability here, which is something that I really don't like. But I think having a little bit of that in there gives you a really good kind of cushion. And I think that one way you could play this is you could buy into this, and then you could sell at a target price that you want to get on a return for your initial amount invested. Or you could hold this for the long term, because I think they're really doing the right things. And I think that this stock is currently undervalued according to the valuation metric and just the nature of the business. Let me know what you guys think about this company in the comments section below. Thank you again to Omaro1910 for recommending me to review this stock. I thought it was really fun and an interesting kind of gem that I think I want to add to my own portfolio, because it fits my own personal needs. If you've made it this far, please hit the subscribe button. It helps the channel out a lot. And please leave a like on the video if you liked it. Leave a dislike if you didn't like it. Thank you for watching. Bye.